The Rebel Capitalist Show. I think that you are just spot on by saying that the 2020s will most likely resemble the 1940s. And what I'm referring to specifically there is if you look at a chart of inflation in the 1940s, you have these huge spikes. And then, I mean, I think one spike even went up to like 18 or 19%. And then it comes all the way back down to zero. Then you have another huge spike. And then at the end of the 1940s, or right around that time, we actually had significant deflation where prices, as measured by the CPI, were down, I think, -2, -3%. And it's all a result of these government uh, distortions, let's say, with supply shocks, or maybe it was, short-term, quote unquote, money printing that wasn't sustained long term. And so you just see these dramatic spikes up and down. Do you want to expand on your views of the 1940s?
Yeah, I view it as being similar to the 40s. And so when people think about inflationary decades, they often think of the 70s, right? Because you had high
Yeah.
inflation, you had high interest rates. But there were a couple key differences there. One was, that was very much bank loan driven. So there were fiscal deficits as well that kind of compounded that. But you had money supply was going up because you had both bank lending and you had fiscal spending, and you had again a resource constraint. So American oil production peaked in 1970.
But
And so
that
the
would be more consistent with the Austrian definition of inflation, and that it isn't necessarily prices going up, but it's more so an expansion of the money supply
Yeah, you had money supply going up, and then it also
because
translated
of
to
the bank
prices.
lending. I just wanna
Yeah.
clarify that for the viewer, right?
Well, and then also, I mean, Austrians, I think they talk about the increase in the money supply for multiple reasons, right? So in Turkey right now, money supply is going up rapidly. It's not necessarily because of bank lending. It's because you're basically running those fiscal deficits, and that actually goes back to the 40s, where the difference between the 40s and the 70s was that the 70s inflation was very much in large part led by bank lending, whereas the 1940s was bank lending was minimal, but the money supply was going up substantially because of fiscal deficits. So basically creating new money in that sense. So not just
Mhm.
QE alone, but that QE combined with that fiscal spending that actually got money out into the economy, and build things with it, increase the money supply. And the interesting thing about kind of the inflationary spikes you had in the 40s is you say you have 19% year-over-year inflation, which you did briefly. A period of 3% deflation does not take away those price increases that happened. And so actually if you when you look at it in year over year terms, you see these big three inflationary spikes. You see one or two very kind of minor deflationary periods. But when you look at the CPI in absolute terms, essentially what you saw is these plateaus. It would spike up to a new level and then just stop going up, maybe go down a tiny bit, and then it would spike up to another level and then level off. And so over that 10-year period, prices went up 80 or 90%, and that was just their new high watermark. So CPI went
Yeah.
up that far, and then it never came back down. So if people were holding bonds or cash, they just permanently lost purchasing power, and it just wasn't, it didn't just keep compounding into hyperinflation. It eventually stabilized back then. Of course, there are different environments. The United States had a trade surplus back then, and they didn't have the entitlement demographics issues that we have now. So there's a kind of different analog overall, but essentially in that environment they were able to eventually slow that inflation in large part because they just stopped doing those very large fiscal injections that was causing the inflation because it was different than bank lending.
Yeah.
And so but you
Oh, go
didn't
ahead.
actually you didn't actually claw back all those price increases. Those were now the permanently high levels.
So how would you define the 1940s in today's terms? Because I think a lot of the controversy, or going back and forth, a lot of the debate is just in semantics. It's not really in concepts or ideas. I mean, the 1940s, would you consider that transitory inflation, or would you consider that secular inflation?
I would consider that secular inflation because you had a permanent increase in the broad money supply and a permanent increase in prices.
Okay.
And that doesn't mean you have a new permanent level of annual inflation, right? So that's the difference between, this was the point I was making earlier because this was kind of a kind of a question I knew would come up a lot and would confuse, especially a lot of people that don't follow finance closely,
Yeah.
is the difference between transitory and rate of change terms and transitory and absolute terms. So transitory and absolute terms would mean that say there's a specific supply bottleneck and prices soar. Let's say a gas line breaks and my state can't get gasoline. And so
Mm.
we have this huge spike in gas prices. It's very localized. And then eventually that gets fixed, and also, people get trucks and they bring over gasoline, and people cut down their gasoline usage temporarily until that problem's resolved, and then prices go back down to kind of normalize with the nationwide average. That'd be an example of transfer in absolute terms. We eventually claw back all those price increases, and that can happen on a global scale if you have something like a specific industry gets disrupted. Let's say the biggest copper mine goes offline from a flood, for example. You have a temporary increase in copper prices until that's resolved. Same thing with autos or things like that. So that can happen. Now, what we saw in the 40s was the different kind of transfer inflation, which is, you had this big permanent increase in prices, but the rate of that annual year-over-year inflation eventually stopped happening. You eventually went back down to low year-over-year inflation,
In the
but you didn't.
1950s, early 1950s, right
Yeah,
after that
yeah,
deflationary period in the end of the 40s, right?
yeah, by the time you got to the 50s. And so you no longer had that structural inflation ongoing, but those prices were locked in stone. Across the board, you had broad permanent price increases as well as a broad permanent increase in the money supply as measured by M2 or M3 or different ways to measure it.
Mhm.
And so people had more money in their bank account, things cost more, but then they stabilized at that higher level. And so that's why I wouldn't consider that overall to be transitory inflation.
Okay, so I think the takeaway there is people have to consider the supply side of the equation when considering how permanent or not permanent. I guess permanent isn't sustained. Let's say if inflation is going to be sustained, they've got to look at those potential supply shocks because it sounds like we had those in the 1940s, just like we're having those today.
Yeah, I mean, in the 40s and also the 70s, part of the kind of the temporary halting of inflation, you see these wage and price controls kick in, right? And so if you look at both the 40s and the 70s, inflation was never a straight line. I always joke that, if you imagine if Twitter existed in the 70s or the 40s, and you'd have like the inflationists and the deflationists, they'd be taking turns kind of, declaring
Dunking
that they.
on each other.
Exactly, because there were these periods where it's like, look at the prices going up, and then it's like, oh, look, now we have
Yeah,
negative 1% inflation. Oh, look, now
yeah,
now it's
yeah.
19%. And so I think we're gonna, now we're in 2020s, we're gonna see that happen in real time, where I think we're gonna have this kind of irregular environment, and there are gonna be periods of time where it looks like it's transitory, and then oh, maybe it's not, and then but I think we actually saw a little bit of a fake out there where inflation was leveling out for a period of time, and now it's being driven by other things. It's being driven by housing, and so we're kind of getting another leg up in inflation. And so, but that's still kind of a smaller version. If we have, say, let's say there's congressional gridlock in late 2022 from an elections, and let's say fiscal spending dries up or at least slows down, decelerates. I think you could certainly have a period where inflation kind of levels off and goes down for a period of time, and then it comes down to what the response is going to be in that situation. So I think by no means is this going to be a smooth decade. It's not like this inflation is going to be right for 10 years. I think
Mhm.
it's kind of like, I think adding it all together and looking back from the end of the decade, I think we'll have said inflationists were generally right. That's my current base case. It's been my base case for a little while, but I think there will be individual years where they're not right at all.
Yeah, yeah, and just for the average viewer out there, in the 1970s, you had this up and down and up and down and up and down, but you kinda had that up and down between, let's say, 5% and maybe 15%, and what made the 1940s different was, those spikes up and down were between 19% and -3.
Yeah.
So kind of a different range there. So without getting into the plumbing of why it happened, just kind of the headline numbers. That's what you're expecting, and kind of that's what I would expect as well. And it's really based on kind of the government. You've just unfortunately you have to start answering economic questions by answering political questions first.
Yeah, I mean, and you have to do it on the global scale as well, right?
Yeah.
So the United States used to be the major global driver, and it's still one of the biggest. But you also have to look at China and Europe to varying degrees. And so, basically, certainly China can affect iron market, for example. All these different countries based on their fiscal policies and which things they let happen, and the timings of which they let them happen, influence these things. So I think when things start showing up on popular financial magazine covers is when you have to start really considering, okay, this might still be right in the longer term, but it's not going to be a straight line of the way there. Once everybody is on one side of the boat, the boat, turns over, shakes out some of them, and it kind of then it goes through another cycle. And I think that's how we have to approach it.
To your point, I wouldn't be surprised if 2022, 2023, we had a CPI print, and even though it's kind of bogus, but that CPI print go back down to 2% and shock everyone, and then the very next year, based on government spending or another supply shock that's created by government distortions in the economy, it goes right back up to 8% or 7%. What did other asset classes do in the 1940s? So I'm curious what the stock market did and the housing market.
So the housing market did great. They came up from very, very low levels. The stock market started to do very good after 1942. So once the United States had a couple decisive victories in the Pacific,
Mm,
and it started to look like, basically the United States was going to be okay, and that this was, there's still kind of a long grind ahead of them, but that it was looking favorable. The market started to do very well. So stocks did well, housing did well, commodities did well, and gold was pegged. So gold was kind of a non-market, but silver did well, for example. And so another caveat, though, that I like to point out is that stocks went into that period very low priced.
yeah, so
They went.
I was just gonna say that before everyone gets excited, just time out here.
Yeah, so if we go back to the 40s and the 70s, the difference is in the 70s is high inflation and high rates. So that's of course bad for equities,
Yeah.
because their whole discount rate changes. Plus, some of them have issues with payment timings and things like that surrounding inflation. In the 40s, that was generally a more favorable environment for equities because you didn't have the higher interest rates, and you had that more kind of high nominal GDP growth, high inflation. So that was favorable towards equities. The example that we don't have is what happens if you get a 40 situation, but equities go into it at record high valuations. We don't really
Or
have
housing. Or housing,
or
same
housing
thing.
or housing. So we don't really have that kind of test case. That's the challenging thing. I often point out that even though I think overall the 40s are a much better representation of the 2020s in terms of fiscal monetary policy, it's not necessarily a good equity comparison. If anything,
Yeah.
the late 60s are some of the closest equity comparisons, because you went into that period with the Nifty 50, they call them, right? So the 50
Mm,
stocks that you couldn't go wrong buying. They were things like Procter and Gamble and Disney and Coca-Cola and Xerox. And many of them, those companies went on to do absolutely phenomenal for 20, 30 years in terms of their fundamentals and earnings growth, but they did terribly for 15 years in terms of stock returns because they started the
mm,
period at such high valuations.
right.
And so, I think that the both the dot-com bubble as well as the late 60s are kind of instructive, I think, for where we are in terms of say maybe forward equity performance on a real basis.
Yeah. Yeah. Great points.